Misgivings over the use of AI in banking have given way to its ubiquity across all areas. But while the power of AI is undisputed, human oversight and intervention is not just necessary, it is a regulatory requirement in most cases. But its effectiveness is only as good as the domain knowledge these humans can bring to bear on their activities. Here are 5 hidden areas where the role of humans remains critical to mitigate risk in AI-driven decision-making. The power of AI in terms of information processing means there is an understandable tendency for people to rely on the technology as if its output was unimpeachable. Given that assumption, the natural approach of banking practitioners is to absolve themselves of responsibility for its decisions. But regulators are not accepting the argument that the model did it, and management remains on the hook for decisions made with AI tools. This is a key principle. Governance and accountability risk in AI is acute for the reason that AI decisions often sit between traditional control categories. For example, a chatbot may be partly customer communication, partly advice support, partly complaints handling, and partly data processing. With AI decision-making, personal ownership must be explicit. Otherwise, risks fall between departments. Ultimately, someone must answer, would I be comfortable explaining this decision to a regulator? It remains for human managers to approve use cases, establish limits, determine accountability, and challenge unexpected outcomes. Depending on jurisdiction, that requires detailed appreciation of areas such as consumer duty, MIFID, AML, data privacy, and conduct regulation, together with risk management concepts such as 3 lines of defense, risk appetite, and escalation procedures. Model risk is nothing new. It already exists in credit scoring, fraud detection, stress testing, pricing, capital modeling, and trading analytics. But generative AI adds new risks: hallucination, inconsistent outputs, prompt sensitivity, weak source attribution, retrieval errors, and plausible but wrong explanations. One of the notable characteristics of banking and finance is that rare events tend to be the most material. Financial crises, liquidity spirals, cyber incidents, and market crashes are low-frequency, high-impact events. Ironically, models trained mainly on normal data may be least reliable when judgment is most needed. Humans provide the reasonableness testing and challenge to AI models. So, for the credit officer, that means understanding concepts such as leverage, cash flow, collateral, covenant structures, and industry cycles. For the investment officer, valuation, market structure, and an appreciation of economic cycles remains essential. AI is only as good as the data it is fed, but banking data is fragmented, sensitive, and heavily regulated. The result? Poor AI outputs. Data-related issues are among the top perceived AI risks, and the Financial Stability Board (FSB) has warned that common data sources and models can create concentration and herding risks. Bad data frequently looks plausible. Humans assess whether data makes commercial sense. On the operations side, this means having detailed knowledge of source systems and data lineage. Critically, that must be complemented with product knowledge and an appreciation of expected customer behavior. So, for example, when AI identifies a large increase in deposit balances, an experienced treasury manager is on hand to assess whether this is down to a reporting change, if the nature of the balances are temporary, and whether there is a genuine improvement in the liquidity position. AI can improve service, but it can also compound poor treatment of customers at scale. In retail banking, the main conduct risks are mis-selling, unsuitable recommendations, exclusion, unfair pricing, poor vulnerability handling, and misleading explanations. This is perhaps the area where human judgment can make most difference, practiced as it is in recognizing the nuances behind human conditions such as vulnerability, distress, coercion, confusion, and hardship. Discrimination can be an unintended outcome of AI. Models may use variables that correlate with age, gender, ethnicity, disability, income instability, geography, or digital access. In banking, this can affect lending, pricing, fraud controls, collections, authentication, and service access. Bias testing must go further than technical fairness metrics. It should include customer outcome testing, vulnerable customer impact analysis, and review by people who understand banking products and customer behavior. That requires fair lending and conduct specialists with knowledge of discrimination law, lending practices, customer demographics, customer outcomes, and regulatory expectations.